Yeah, I moved to Delmar.
Nice. Love Delmar.
That's probably the kind of thing I should have said before we were on the air. But yeah,
Yeah, I
so
agree. Sorry. All right,
somewhere
we'll
else
catch
in
up
Southern
later. We'll catch up.
California.
We'll
Yeah,
catch up.
not that far. It's still nice.
No,
It's a
that's
good thing. It's a happy move.
definitely God's country down there. Do the trains
Yeah.
still run through there?
Yeah, and I can see it. It's where I was before it blew the whistle. I'm in a
Oh wow,
whistle-free zone, which is awesome
that's
because
good.
it's like
That's
living
good.
in a little kid's kind of toy
Yep,
train set. It's like, oh, here comes the choo-choo, and it just kind of chugs by nice and quietly.
that's
It's like a
funny.
sleep machine. It's
Yeah, I
good.
love that.
Yeah, it's
I
great.
love that. All right, let's get this show on the road. Welcome
Yeah,
to Wall
it's
Street
Southern
Beats,
Cal.
everybody. I'm Steve Lamar, joined today by our banking and financials pro, Charlie Peabody, and our retail pro, Jeff Macke. Unless you were sleeping under a rock, Google and Tesla both reported, and they're both down quite a bit this morning. I don't know if we want to talk about that at all, but that's I'm sure that's top of mind for a lot of people who have at least one of those in their portfolio. And then we got the Houthis acting up, and oil's ripping again. Markets look like they're down. We got the Fed next week. What's top of mind for you guys? You want to start? You want to start, Charlie?
Sure, I can. Just on Google and Tesla, obviously not my bailiwick, so I'm going to defer to everybody else. But the one thing I will say, and I've written about this and actually posted a piece this morning that I wrote a week or so ago. It's all one big trade. AI, data centers, chips, all one big trade related to capital markets. And that's where all of the beat and raises for the banks are in capital markets. And if the AI data center chip trade comes unwound, so does capital markets revenues. And that's why banks are weak today. So anyway, just wanted to put that out there. And
Jeff,
you can
did you have a before we move on? Did you have a thought on the Tesla or Google prints, one way or the other?
just negative
I
cash
blew
flow.
them off, to be honest. I mean, it's. I think the summer is really drifty. To Charlie's point, it's all one big trade, and I think that's partially because it's all one big trade. We've just backed ourselves into that kind of corner economically. But the other thing is, it's summer, and you got kind of bosses calling in and saying, "Give me the story," and oh, Google spent a shit ton of money. Well, sell everything. It's I think it's kind of it's classic summer action, but we were due for this and we're getting it, and it makes
Yep,
sense. So
summer
people are going to
atrophy.
run with it. I
Okay.
I still live in a world where the consumer. I'm looking at IMAX this morning, which is just if we're still doing what's on people's radar. I don't think that a lot of people don't pay attention to this. It's only a 2 billion market cap. They kick the crap out of numbers. I'm going to end up with a consumer with this company because they sell $31 tickets to movies. It's that tells
Yep.
me two things. It tells me one, this is the obvious solution for if you're a movie theater company, is that you need to make nicer screens with bigger pictures, and you need to make the experience. And two, consumers will spend money. Like, it's a consumer that's truly strapped and down to the last penny will not buy $35 IMAX tickets when they can go to it for $10 down the street. So, with this premium experience, and the stock's up 14% today. I
Wow.
take it the rest of the market's crappy. I've been really kind of absorbed with a lot of other stuff, but yeah, kind of looking through the bloodbath, and I'm having a hard time being in a bad mood because I just heard the Happy Canadian movie theater company chain that should be acquired for like $60 a share say all kinds of good things, and so
That's good. I assume a
it's
lot of
yeah,
that has
it's
to do
okay.
with their guide and the success of the Odyssey, and that can't hurt.
Well, it's more kind of at this point, they got a huge boom from Oppenheimer. Christopher Nolan's obviously been great for these guys. But beyond that, this is just kind of more proof of concept. You also have Dune 3 coming out, which is going to be all IMAX original content, meaning they shoot it in the 70 millimeter and then cut it down. Um, so the more kind of tentpole, huge budget movies that you can get being made this way, obviously it's great for them. And to the prior point on what the consumer wants, what they don't want is kind of the standard AMC experience. So IMAX is also in the business of upgrading other people's theaters, and then they take a chunk of the revenue. That's pretty good. The install's a pain in the ass, but once you've installed it, you're just collecting a chunk every time it comes out. Every good movie that's shown in this function, that's a good business. That's a nice high margin cash flowing business. And it's the supply chain. Amazon, or Netflix rather, is releasing a film straight, the Once Upon a Time in Hollywood sequel or prequel with Cliff Booth. They're going to release that in IMAX whenever it comes out. It's another story. But
what
at
is an
that point,
IMAX ticket these days, Jeff? Last time I
about
was there, it was
35
roughly
bucks.
almost. Oh, it was $25. Okay, I
35.
remember it being higher, but yeah, okay.
It's 35. And that's you can actually kind of like StubHub these. They're sold out for reasonable times.
Right.
It's kind of crazy. So they only really have about 25 of the full-fledged theaters. So small company, small footprint. But if you're Netflix, you can buy them for what you saved in breakup fees or payback just from the whole Paramount fiasco. It's just a rounding error. So
Do you think
I still like the company.
you think this could have a six handle on it here soon?
Soon enough. It's looking towards all-time highs if it kind of stays where it is right now. And again, stocks are financials and narrative. This is a pretty decent narrative, and you can make a pretty strong financial case that, again, if I were Netflix, you just swallow them and you own the whole pipeline. If you're Amazon, there's never been a supply chain they didn't want to dominate from soup to nuts. So take film.
All right. Sorry, Charlie. We went off on a little bit of a tangent there.
That's right. I was just going to support what Jeff said.
Where were we before we cut you off?
Yeah, I was just going to support what Jeff said about the consumer. I mean, all the banks, just reported earnings. They all talked about how resilient the consumer was. Credit card spend is still growing, 5, 6, 7% year over year. So,
claims numbers this morning look good.
Showed a very strong jobs, number. So I agree with Jeff. The consumer remains resilient. And the credit quality data, you're seeing declines in delinquencies on cards at my bank. So I will say, and I wrote this about a week and a half ago in a piece, this credit cycle, every credit cycle is different. And sometimes it's led by the consumer, sometimes it's led by the corporate market. This next credit cycle, whenever it happens, and I think it's going to start showing up in the second half of this year, is going to be led by corporates, not by consumer. And the only way the consumer is really going to be forced to pull back is we get a significant correction in equities, which we may get. I must say my bias is that we will get. But that wealth effect from equities and securities has been just dramatic in terms of what it's done to the spending at the high end. So I wouldn't expect any pullback until we get some significant correction in the markets.
And is that a leverage issue, Charlie, or just
very much so? So last week, or was it this week? I wrote about it. I can't remember. I wrote so much. The margin debt for the month of June came out, and as a percentage of GDP, it's at a record high. But more importantly, the rate of change over the last 3 months, the 3-month rate of change was up 23% in margin debt as a percentage of GDP. We have only seen that twice in history. Once was 2 months before the tech bubble burst around the dot-com period, and the other was 4 months before the peak in 2007 in the great financial crisis. So it's kind of supporting my thesis that we're going to have some kind of significant equity deleveraging event before year end.
Okay.
So we'll see.
That could cause the consumer to at least slow down a little bit. I know everybody's been calling for the death of the consumer for 2 years, Jeff, and Jeff's been saying no, the consumer's just fine.
I mean, that would do it. That would absolutely do it. Charlie and I aren't disagreeing. There's an absolute wealth effect driver to this. It is, when you see rounds of golf up, when you see stocks like Callaway doing well, they're just, people will fight you on this, which is what's so weird. There's all the data Charlie's pointing to. There's all the kind of company specific stuff I'm pointing to, and people will still say everyone's a moron. They're spending on credit cards that they can't afford. Blah blah blah. It's the wealth effect. It's everyone's kind of we're back to a gentleman farmers kind of investing in things and playing golf all day type of economy, or at least there's whispers of it out there. I'm not sure how eminent it is, but that is, you can't just dismiss that as an idea.
Yep.
And anticipating the demise of the consumer has been a bad trade. So I'm with you.
For sure.
Wait until it happens.
And there'll be plenty of room when it happens. If when this is a trade that you don't need to catch, there's plenty of time.
You don't need to catch the top. Right.
No, you do not.
The other thing I was just going to say, Steve, because you started off the show on Google and Tesla, I think their declines today is all related to the fact that they're negative cash flow. I mean, this is the first time that Google's gone negative cash flow. So the CapEx spending continues to outstrip expectations, and I think the market doesn't like that.
Yeah, and their P&L looked a little suspect. I saw some notes about the SpaceX gains and how
$100 billion of investment gains. And that's what you saw in my big banks. So if you look at the Goldman Sachs, the Wells Fargo's, venture capital gains were a huge part of their beat and raise quarters. And again, this is all tied to the markets. I mean, it's all one big trade, as Jeff said. And if markets turn, none of this revenue is going to be there in the future.
Yeah. Well, they got a few. They got an Anthropic IPO to get off and an OpenAI IPO to get off. You think they could hold it together until they get those out?
So, but I have an idea, not a new idea, but I want to reiterate another name that is not tied to the capital markets, but tied to commercial real estate, which is a contrarian play. But as I've been saying, for the last 3 quarters, the banks have been all saying we're starting to re-lend to this commercial real estate space. And that's after several years of degrossing their exposure to CRE. And the name that I continue to buy on dips is Flagstar, FLG. They report tomorrow morning. And I just wanted to sort of highlight the things to look for. The first is, are they profitable? And they started turning profitable in the fourth quarter of last year. They were profitable in the first quarter of this year. I think they'll earn about 4 cents. I think street expectations are probably too high at 6 or 7 cents a share. But profitable is important because that starts to solidify the idea that book value, which is between 15 and 16, tangible book value, which is between $15 and $16, is real. And this thing still trades at 14 or a discount to tangible book. And I think it can trade back up towards tangible book, which by the end of this year, I think is going to be close to 17. So that's my price target by the end of this year. The second thing, and this is now the incremental story, is the balance sheet starting to grow? So this is a company that was almost failed because of their exposure to commercial real estate. And they've been having to shrink their commercial real estate portfolio dramatically. When you shrink the balance sheet, it's hard to grow net interest income or top line revenues. But this quarter is supposed to be the first quarter where the growth in C&I, corporate and industrial loans, starts to outstrip the shrinkage of CRE or commercial real estate loans. And so you should start to see some growth in the balance sheet. I'm not sure it's going to be net a big growth, but it's the transition period, kind of like the fourth quarter of last year was the transition period to profits after 2 years of losses. And then the last thing I just want to mention is the efficiency. So efficiency ratio. So something like 85 to 90% of their revenues are eaten up by expenses. So it's a bloated expense base because of all the problems they've had. And that's what we want to see, an expense ratio somewhere closer to 55, 60%. So we want to see progress on that efficiency ratio. So those are the 3 things I would look for. I just remind people, I mentioned this before, they had a slide deck out there from April, which they said they were going to earn 60 to 65 cents this year. That was hogwash. They're never going to earn 60 to 65 cents. So they're probably going to have to revise that downward. And the stock could sell off as they revise down their earnings expectation. But this is not a story about how much they're earning. It's just a story about, are the key transition or progression metrics moving in the right direction. So Flagstar is a name I like.
So if you didn't own, I asked this to everybody, Charlie, as you know, if you didn't own it, would you buy it here?
Actually, at around 14, I have been buying it.
Okay.
So 14 plus or minus. Every time it dips into that area, I do buy it.
Okay.
But I've
And in
been
terms of position sizing, is it a like lotto size, or is it a little more substantial?
it's more than my average right now, but I have
Okay.
room to add to it,
Okay.
and probably will. Ultimately, I think this is a Steve Mnuchin, the former Treasury Secretary, turnaround situation, and he has a history of doing these things and then selling them off, and that's my ultimate payday. Is this thing's going to get sold at some premium to tangible book? So if tangible book becomes $17.27, and you get
Maybe
one
it
and a
sells
half
for
to two
20.
times that,
Yeah.
that's kind of where I'm looking for the upside.
Okay. All right.
Um,
Mr.
the-
Macke,
the-
anything else on your mind this morning? I saw you.
Um,
I saw a note about was it Deckers? Did I see a
Deckers,
note about
it's
Deckers?
there tonight. That it's that stock has been kind of 100-ish for a long time. I'm not sure they say anything tonight that's going to break them out. These consumer companies, the problem they have is that they can come out and tell you everything's fine, but what they can't argue with is the sort of if then kind of wealth effect trade problems, or whether how's the Strait of Hormuz doing if they are dumb enough to have exposure on that. They can't tell you what gas prices are going to be. They just it's and so I think Deckers will be fine.
Yeah.
The worries that Nike's going to come and just boot stomp everyone because they're revitalized are proving unfounded, to be polite. So Deckers will be fine. I don't think it's going anywhere particularly fast. It's we'll see. It's the other problem with these sell-offs is it can be the run from all these tech companies that starts it, but correlation just starts needling up to about
Right.
1 as you go throughout the day. So, am I going to hide in Target? Well, that's probably not the best hiding place on earth right now.
Right. Yeah. They just take all the risk down.
Yeah.
Steve, tomorrow we get the new home sales data, and I just want to quickly preview that. Jen, if you can put up the first slide. So new home sales for tomorrow, you can see that green box in the second column is estimated around 605,000 to 610,000. That would be up month over month by about 5%. So pretty robust number, actually. But I think there's room for disappointment in that number, largely because of what we saw last week or the week before, and that was the NAHB, which is the home builder sentiment index. And Jen, if you can put up the next slide. This is the home builder sentiment index, and it came in at 34, which is a pretty depressed number. That's that very bottom, dark 34.
Bottom center. Yep.
Yeah. And the last time we had this, home builder sentiment index this low was, prior to the 2007, 2008 financial crisis, great financial crisis, when housing was the centerpiece of that recession. So if you look at current sales conditions, so this index is made up of 3 components. Current sales conditions was near historic lows at 37. Future sales expectations over the next months, again, near lows of 43. And the traffic of prospective buyers came in at 23. All 3 of those components are near historic lows and decline month over month. So you're not getting a lot of positive signs out of home builders. And with the way rates are rising today, I'm sure they're going to be even less excited about the home building environment. Recent data showed that 37% of builders had to cut prices in July in order to move product. That's up from 32% 2 months ago and 35% last month. The average price reduction again was 6%, and the use of sales incentives for home builders, over 63% of home builders now are reporting and need to use incentives to move product. That's the 16th consecutive month that we've seen this. So I would say the home building, and I've been negative on home builders, I think, since September of 24. I just don't see any reason to buy the home builders here. I think maybe next spring will be your first opportunity. So I just wanted to get that out of the way. I think there was one more.
Are you shorting them?
Yeah, this just shows the existing home sales, not new home sales, but existing home sales continues to run around 4 million annualized per year. that's been the rate for the last 3 years. That's a very depressed rate. Usually it's 6 million plus. So again, the home market is just not attractive, and there's nothing coming out of Washington that's going to make it more attractive.
So Charlie, you said you weren't buying them. Are you shorting them?
I have been. I took it off. So I'm not. The answer is no. I'm not short them now.
Okay.
But I might. I mean, this rate structure is shifting quickly, and could put a real another leg down in the whole home building market.
Do you have thoughts on next week's Fed meeting?
Yeah. So we meet on. We get an announcement next Wednesday, the 29th of July, and I think under Warsh, things are obviously going to change, and this is how it's going to change. First, we get the statement, all right? That statement is probably going to be less than a half a page. It used to be 2 pages long, and that statement is not going to have any forward guidance. So the market's going to be left to their own devices to figure out where he's going. The second thing is in the vote, we could get dissent. Lori Logan, Beth Hammock, Kashkari probably are going to dissent and ask for a hike. I don't think we're going to get a hike, but you're going to see dissent. And since there's no discussion, since
there's no guidance, right?
Yeah, no guidance. That's going to create some uncertainty and volatility as to where the Fed is going. And then this meeting, FOMC meeting, we do not get the SEP, which is the dot plot. So we don't get that dot plot, sort of giving us a sense of where people on the committee are standing with respect to hike, hold, or lower. So there's going to be a lot of uncertainty around this meeting unless we have a press conference. And that's, again, something Warsh does not want to do. He does not want to hold a press conference. Now, if he does hold a press conference, that means something has changed. And he will call that literally at the last minute. And so what would have to change would be a decision to hike rates. And that's going to be the
if he calls a press conference, batten down the hatches.
Yeah, exactly. But that would probably come out in the statement, half an hour before he holds the press conference. But you have to put in perspective, before the election, you've got 3 FOMC meetings. Next Wednesday, then you have one on September 16th, and then one on October 28th. If he does not hike next week, which I don't think he will, he's going to probably have to hike in September because the October 28th meeting is too close to the election. So you only have 3 FOMC meetings before the election. So I think we're looking at a September hike, and the markets are going to sell off in anticipation of that. That's been my bias. So we'll see.
Okay. Do you think there's a hike coming right after midterms? Too early to tell.
Yeah, I think it's too early. One of the things that Warsh said when he was first appointed and was asked about, the inflationary pressures, he said it varies depending on what asset class you're looking at. And he said there's not a lot of inflation in housing. He specifically talked about housing. He wants to get that long end down. But he did say there's a lot of inflation in financial conditions or financial markets. And I wrote a piece, which I published, I think, on Wall Street Beats, entitled "Warsh is Putting Markets on Notice." I think he wants to bring the markets down, and that's why I'm expecting a significant correction between now and year end.
Yeah, just like when Powell started, he came out with a big puffy chest. We'll see. We'll see how long that lasts.
Yeah, I mean, it's a fine line to walk. He obviously doesn't want to push us into recession, but he wants to. If he's being serious about reining in inflation, he's going to have to do something about financial conditions and get them to tighten. And the markets are doing it for him. I mean, we've got a 30-year at 518, a 10-year at 460 something.
Yeah, almost 470.
Yeah. So the markets are starting to tighten financial conditions for him, and that's what he wants. So he doesn't have to take the blame it on the markets.
Yeah, because taking the blame in this administration, he'll literally be shot out of a cannon if he hikes. I mean, it's a professional decision. It's a career kind of making or breaking. It's like it's more than ever. I mean, it's The
Well put,
president is
Jeff.
very
Well,
extremely aware of what the stock market's doing. It's he told us to buy Intel. We should have all bought Intel. What the hell are we
Right.
possibly thinking? I mean,
He told us to buy Dell. Same thing. Right?
Exactly. It's why didn't you do that, honey? That's a tough one to answer when the missus
Just
is
take him at his
curious as to
word.
why you don't. Yeah, just
Yep.
because that's what he's going to do. So we'll see. We'll see.
All right, gentlemen, good show. Let's wrap it up there. Thanks for following us on Wall Street Beats. Thanks for watching today. We will be back here on Monday. Have a great day, everybody. Have a great weekend.
good weekend, guys.
Take care,
Thank
folks.
you, guys.
Thanks, Steve. Thanks, Jeff. Thanks, Jen.